All right, thanks. Good afternoon, everyone, and welcome to the webinar. Today, we're fortunate to have Mark Viviano of Kimmeridge with us. How you doing today, Mark?
I'm doing great. It's a pleasure to speak with you.
So Mark's going to talk to us a bit today about the current state of the industry and what the future might hold. So Mark, talk to us a little bit about your background and how you came to be with Kimmeridge today.
So I joined Kimmeridge in February after 17 years at Wellington Management, with the last 15 years spent investing in the energy sector. And over the last few years at Wellington, I had just grown increasingly frustrated that the E&P sector had become uninvestable. Initially, it was the legacy issues around flawed capital allocation philosophies and the failure of corporate governance, but increasingly it was the mounting risks associated with the energy transition. I would have PMs at Wellington say to me, why would I bother investing in energy when oil is going away in 10 years? And I didn't think the industry had a good response for that question, particularly when they were continuing to pour all of their capital back into the ground to grow oil and gas production. So ultimately, I came to the conclusion I either needed to abandon the sector or find a way to reform it. Obviously, at Wellington, we were engaging with the CEOs and the boards on these issues, but it became clear to me that any progress we were making through that approach was far too slow and incremental. And what I also saw when I was at Wellington was that as soon as an activist was involved with a particular company, there was a heightened degree of engagement with shareholders, especially at the board level, and this acceleration of change. So the attraction to me of joining Kimmeridge and launching a dedicated activist strategy was that ability to play a more direct role in catalyzing the change I thought was going to be necessary to allow the sector to become investable again.
That makes a lot of sense. Although abandoning the sector altogether probably wasn't a terrible idea.
I have to say, it was quite tempting at times.
Of course. With that context, maybe you could share with us kind of your view of the state of the market today.
Sure. Obviously, the second quarter was historic when you look at the magnitude of the recovery in both oil prices and energy equities, but it's important to understand how extreme that dislocation was in March and April. You basically had stocks trading at unsustainably low commodity prices, so something around $35 a barrel with trough multiples. And a lot of that had to do with the idea that the duration of low prices was so uncertain and balance sheet leverage was so high that many of the companies weren't going to be around to capture the recovery. But the Fed rescued the credit market, and the shock of negative oil prices prompted the response from the shale industry and OPEC that was necessary to balance the market. So obviously, there's still tremendous amount of uncertainty on the economic outlook and what normalized oil demand looks like coming out of this crisis, but the extreme downside scenario has been taken off the table. And so today, if you look at out to 2022 as some sort of normalized environment, the E&P sector on average is discounting around $40 to $45 oil at a 4 to 6 times EBITDA multiple. And we spent a lot of time looking at other sectors, whether it was refining or tobacco or rail. And it's pretty clear there's a consistent pattern of when reinvestment rates fall and returns to shareholders inflect meaningfully higher, you get multiple expansion. So that's really the opportunity in the sector today. But if this industry just goes back to reinvesting all of their cash flow for profitless growth, we're going to continue to see the trend of multiple derating we witnessed from 2017 to 2019 continue.
Yeah, no, that totally makes sense. Certainly the call for return of capital has been getting louder and louder over the last couple of years. Well, so when you think about the different companies and those that are more oily weighted or gassy weighted, where do you think the most value is today? And does the energy transition play into this view for you?
I personally think there's more value in oil equities today, and that is a function of the scarcity of low-cost reinvestment opportunities. In U.S. shale, it's becoming increasingly evident that the runway of remaining drilling inventory in the oily basins that generates a full cycle return below $40 a barrel is more limited than the market originally perceived. And that record growth we witnessed over the past 5 years in U.S. supply was primarily driven by excessively high reinvestment rates that artificially subsidized the true economics of the business. The whole notion of sustainably running a business for break-even cash flow levels is absurd. And so as that mentality evolves, and obviously we intend to play a role in that, I think the true economics of growing or even maintaining U.S. oil supply will become more evident. And that in that environment, the companies that do have inventory remaining at the front end of the cost curve and can sustain their production at lower reinvestment rates will be valued differently by the market. I think gas clearly has a better outlook from a long-term demand perspective, particularly in the context of the energy transition. But there's just no shortage of inventory in this country that'll start attracting capital as soon as gas goes back above 3.
That's true. At least in the medium to long term, sure. We expect to see some spikes, come this winter, but how sustainable a 3+ price is, like you said, in this country with so much low cost inventory remaining is to be seen, I guess. Well, speaking of the energy transition, we saw BP and Shell and some of these other majors. They're sending a pretty clear message with these asset write-downs and whatnot. Do you think that it's real, or do you think it's just more greenwashing like we saw 10 years ago when BP used the tagline Beyond Petroleum?
So I think they're serious about their commitment to transitioning the business model, and they recognize climate change represents an existential threat to their business, particularly when you think about the social license to operate as a large public company in Europe. But most people are going to be naturally skeptical of targets going out to 2050, or that these companies are well positioned to successfully allocate capital into alternative energy rather than just returning it to their shareholders.
Meaning, like, don't go invest in these offshore wind platforms. Just pay us a bigger dividend. We'd rather you keep to your core competencies, that kind of thing.
Yeah, exactly. I think the burden is on these companies to prove that they can successfully allocate capital to newer businesses and generate the necessary return rather than just giving the capital back to shareholders and allow them to reinvest in those businesses directly.
No, that makes sense. It feels like there's going to be a big tug of war there between the different kinds of investors and what they want these majors to do. So we'll see how this plays out. But as we think back to North American shale and its future, what do you think needs to change for capital to return to the space? Or is it too late? Have we just destroyed so much capital and destroyed so much investor confidence in the ability of these companies to actually generate returns that it's over?
I hope it's not too late, or else I made the wrong decision. But if you look at the white paper we published in March, we outlined our vision for successfully evolving the E&P business model. For these companies to become investable again and to align their business model with the energy transition, they need to materially reduce reinvestment rates to a maximum of 70% at mid-cycle prices while providing visibility into returning 100% of the enterprise value in cash over the next 10 years. They need to reset the cost base to match those lower activity levels, raise their environmental standards, and better align management incentives with shareholder interests. And so under that model, you would start with the assumption that 30% of your cash flow is going back to the balance sheet or to shareholders before anything is reinvested back into the business. And depending on the oil price and the quality of the company's asset base, production might rise or fall, but the production volumes should be an output of the model and not an input. So what we're arguing for is more prescriptive capital allocation frameworks around reinvestment rates and long-term guidance that provides the visibility into how the cash comes back to shareholders under various commodity price environments. From my perspective, that's really the only way you're going to attract generalists back.
That's a massive change from what we've witnessed over the last decade or two in the way, or maybe in the history of oil and gas in America. What is it that'll help change these guys' mindsets? I mean, we've seen activism before. Why is it going to be different this time?
Yeah, you'd like to think a decade of underperformance at the magnitude we've witnessed would be enough of a catalyst for change. In no other sector would you see this magnitude of value destruction, and yet everybody would continue to pursue the same model. Now, these companies will tell you that they're changing, but the business model that they're proposing is just a watered down version of the old model. So instead of reinvesting 120% of cash flow, they're going to invest 100% of cash flow and they're going to refer to that as being capital discipline. And I can tell you, having been in these meetings at Wellington, if you sit across the table from a generalist portfolio manager and tell them you're capital discipline because you only spend 100% of your cash flow, they're going to get up and leave the room. I mean, the average S&P 500 company only reinvests 40% of their cash flow each year. And this industry is celebrating the fact that it's spending 100% of cash flow. Again, in a business where your returns are not covering your cost of capital. I mean, that just makes no sense to anybody outside of this industry.
Yeah. When you put it that way, it does seem a little ridiculous. I mean, so what does this industry look like if we only reinvest 40% or 50% or 60% of the revenue?
Yeah, it's a good question. It's going to vary greatly by company. The point of this is not that not every company is going to be able to grow or maintain production at those sort of reinvestment rates. But in a commodity business, there needs to be more dispersion in the output, particularly from a volume standpoint. So we think the well-positioned companies with low-cost assets that have scale and the right cost structure can maintain their production by reinvesting 70% at something around $45 to $50 oil. So depending on your view of mid-cycle oil prices and what the service cost environment is, we do think it's possible. And it doesn't necessarily have to be in year one, but these companies have to show the path to bringing down reinvestment rates within a reasonable period of time and how capital returns to shareholders and deleveraging on an absolute basis, not a relative basis, is going to come into play.
Got it. So I guess that means, well, we're already seeing North American production declines, but on a company by company basis, we're going to have to see production declines until that base decline rate gets to a level where you can sustain not a 48% base decline or 47% base decline, but somewhere in the 20s, where you're able to use less of that capital to maintain production or even get back to growth, which seems a far way off. So what do you think this landscape looks like in North America with this kind of capital discipline? I mean, are there 10 companies, 20 companies? It's certainly not the 60, 70 public E&Ps that we see today.
No, I mean, I do think the true rationalization of the industry is going to be driven by consolidation. I mean, there's clearly too many undersized and irrelevant companies drilling shale wells. And while it makes a ton of sense on paper to combine a number of these companies, the biggest impediment, as you know, is the fact that the CEOs and the boards are often not financially incentivized. I mean, why would a well-paid management team vote themselves out of a job? So we think investors are going to play a critical role in forcing these management teams and boards to do what is ultimately in the best interest of shareholders.
So really, once the G in ESG, once the governance is kind of set straight, you'll start to see the management teams act in a way that, like you said, leads to consolidation. Is the only way this happens through activism, or is a capital-starved industry going to figure it out themselves?
Well, I mean, that's really the question: is what is the capital availability going to look like? Clearly, the worst thing to happen to this industry was the prevalence of equity and debt financing back in 2016 that prevented a lot of the rationalization that should have taken place at a $30 oil price environment. I think there's optimism that we're looking at a different outlook for capital availability in this crisis. But as you know, the Fed is doing everything they can to prop up the credit market, and we've already seen companies start to be able to access credit again. I don't think the equity market's going to be there. I definitely don't think the equity market's going to be there to fund drilling programs. So I do think capital budgeting and the need for absolute debt paydowns does look different coming out of this crisis. But the desire or willingness for these companies to engage in consolidation, I'm just not sure the catalyst is there outside of investors pushing for it.
Yeah, I mean, I feel like every time we have a downturn, everyone's sitting there calling, oh, we need consolidation. Now's the time. We're going to see mergers and acquisitions and this and that. And we just haven't. And I think to your point, why would you vote yourself out of a job, especially now when some of these management teams know they're not going to get another shot to come back and get funding based on track records and what future investors are looking for. So I kind of agree with you there. So Do you think, obviously the strip is showing, a $40 to $50 world for the near to medium term. Equities are pricing in a similar price. Do you think we get one last hurrah in oil, or do you think that the billion barrels of oversupply that we have because of COVID keeps a lid on it for the foreseeable future?
Yeah, it's a good question. The range of outcomes on the macro side is as wide as I've seen in my career. The compounding effect of so much uncertainty on both the supply and demand side of the equation makes it difficult to have much conviction on the commodity price outlook. In any commodity business, you can't ignore the element of reflexivity, which is if it did start becoming evident that oil was going to be 60 or 70 instead of 40 within the next couple of years, you would see a shift in producer behavior, whether it's OPEC or the U.S. shale industry, which ultimately impacts those fundamentals. I mean, I personally have more confidence in making money in the sector through reforming the business model and reversing the historic collapse in valuation multiples and trying to predict the next $10 move in oil. I mean, I think the industry should look at the back of the curve in the low to mid 40s today and figure out how are they going to attract shareholders back to the sector. Because as you know, the last thing we want is this industry thinking we're going to get bailed out by higher oil prices.
Yeah, as I've watched the commodity recover from the historic lows this last quarter at a rate that I would suggest is a little faster than industry participants were expecting, and those like yourself who were looking for reform really wanted to see, lower for longer would have been maybe more helpful in convincing management teams that it was time to change. Yeah, it was a little concerning, but here we are. It kind of seems to have leveled off here, $40 for the near term. When you think about the different opportunities, whether it's in oil, gas, minerals, services, where do you see the kind of opportunity, or is it just case by case? It depends on each company and their asset base.
Yeah, I think it is very company specific. I mean, I think it's very hard to say you're going to take a broad-based approach to buying the sector today. That had a lot to do with my decision to join Kimmeridge and the way we're structuring the fund that we're launching. But I think there's opportunities where there are companies that have assets at the front end of the cost curve that have been mismanaged, whether it's capital allocation or governance, and trade at dislocated valuations. I mean, that's really what we're trying to identify. I think there are some unique situations within the sector. But like I said, it's really difficult to say you really want to buy a broad-based index or fund within the energy sector today.
Yeah. So like before or pre-COVID, or however you want to talk about it, earlier in the year, you had seen some of these energy equities start to move higher, and the pundits were talking about, it was a rotation from growth to value, or it was a late cycle rotation into cyclicals. Is there any credence to that? Do we see a late cycle rally into cyclicals? Is E&P really going to benefit from that? Or do we need to see these fundamental changes before the shift can occur?
Yeah, that's a really good question. I'll dodge the first part of that, as I'll try to stick to my circle of competence and refrain from pontificating on the broader market, because as you know, trying to predict when those broader trends are going to reverse is nearly impossible, and there's plenty of people on CNBC that will try to do that. But
sure.
I mean, what's clear to me is that I, along with many others, failed to appreciate the significance of the E&P sector falling out of the growth indexes back in 2015, because putting a U.S. shale company into a value index is like it's a square peg in a round hole. They reinvest all their cash flow. They don't have a meaningful dividend or generate consistent earnings, and the returns on capital fail to cover their cost of capital. So profitless growth just doesn't really work as a value sector. And so value managers looked to the majors or the refiners and pretty much left the E&P sector for dead. The E&P industry needs to recognize they operate within a mature sector with increasing terminal value risk, where they're not going to get rewarded for volume growth. If you want to attract value investors, who are really the only ones who will even consider owning energy today because it's in their benchmarks, it needs to be a market-leading capital return story.
So I remember doing a presentation last summer, and I think we looked at the ROC of all the different major sectors, and trying to think, I think the average was 17% was the average return on capital employed. Whereas when we looked at the best performers in the energy sector, it was that on average like 2%. And I think that just highlights the struggle that you've been talking about. The return on the equity just hasn't been there for a long time. So I guess with that, like, how do we think about the future of shale? Like, or another way to ask it, have we seen peak shale? Are we going to see this M&A or just more bankruptcies and then deals out of those restructured companies?
Yeah, so obviously the management teams are all talking about balance sheets and free cash flow rather than production growth these days. But we've seen this movie before, and it was the same messaging in early 2016. And within 9 months, the entire narrative shifted to how many rigs were going back to work and what growth rates looked like heading into 2017. So maybe we see some structural reform coming out of this crisis, but there's plenty of reasons to remain skeptical. The bankruptcies are coming, but as you know, that doesn't remove the volumes from the market. And in most cases, the management teams that drove the companies into bankruptcy hold on to the keys. So the question is that whether the new owners who are going to be sitting on the boards of these companies adopt a model like the one we're talking about, or go right back to trying to chase volume growth based on flawed NAV math. I mean, I'm trying to be optimistic, but we also know what the track record of this industry looks like. So I think, again, there's plenty of reasons to remain skeptical.
It's interesting. So like you said, there are going to be all these new boards put together coming out of bankruptcies. I'm wondering if they're going to be more easily influenced than the incumbent boards if the new equity holders and board members who were former credit owners learned from 2016 and saw how they thought they could emerge from bankruptcy and generate more value through growth or consolidation. And as we saw, that just didn't work. Is it the same people playing again, or is this kind of a new class of investors that have been moving on to these board seats, in your view?
It's a mixed bag. I mean, you have some that have been long-term investors in the sector, and then you have some that are relatively new. But to your point, the biggest surprise coming out of 2016 was that in that first wave of bankruptcies, you had the creditors take ownership of the companies and have representation on the board. So you had that alignment that you're typically looking for, and yet a lot of those companies still pursued the same growth strategy and the idea of deleveraging on a relative basis through growing EBITDA rather than spending the last few years using any excess cash flow from higher oil prices in paying down absolute debt. And so, as you know, you've seen a lot of companies that are actually going through bankruptcy for the second time. So whether people have learned their lesson and are willing to adopt a new model that's really about free cash flow generation and absolute pay down and return of capital to shareholders, that remains to be seen.
Never good to see Chapter 22 come along.
That's right.
Well, I would be remiss if coming like a firm like mine, I didn't ask you a energy technology question. So what do you think the role of technology and innovation is going to play in the industry going forward?
Yeah, I do think it's a very relevant topic. I heard the other day somebody describe that the E in E&P now stands for efficiency versus exploration. I think technology could play an important role in future efficiency gains. And when you talk to people outside of the industry, they'll usually highlight the fact that the energy sector has been a laggard, whether it's adopting digital technology or cloud computing. And it does seem very applicable to a iterative process like shale development, where companies are repeating a similar task hundreds of times in a given year. And so the idea that big data and machine learning and everything that's coming out of Silicon Valley should be applied to this industry resonates with me. And particularly when you think about a lower for longer commodity price and how you can reduce overhead, reduce cost structures, I do think technology can play an important role there. And we have seen leaders like EOG differentiate themselves from peers. So I think there's going to be more of that. I think it argues for more diversity on boards. I mean, one of the things that we've talked about is diversity on boards also includes diversity of thought and background. And if you look at the statistics, in 2018 and 2019, 70% of new board members in this industry came from the oil and gas industry. And I think it's dangerous to have such a homogeneous pool of directors. I think it does make sense for companies to have directors representing other industries, particularly technology. So I'd like to see much more diversity of thought when it comes to whether it's how technology can lead to efficiency gains or the role of climate and the energy transition in disrupting the sector, and whether board members are appropriately qualified to assess those risks.
I like that. I also like the idea of it being efficiency in production, right? Because, I mean, you tell me, have we found all the great shale basins after this last decade of exploration? And if that's the case, then really all we need to know is how to optimally develop each section. And as we know, all sections are not made the same. And the core is shrinking every day. And it's not shrinking because people are drilling it up. It's shrinking because it was never core to begin with, or what people claimed was core to begin with. And then your idea of diversity on the boards, I didn't even think about that totally makes sense. If you have all the same people on board, it's going to be circular thinking, right? You're not going to be able to innovate in any way. So that makes sense. Have you seen it happening yet? Are you seeing these board changes, or no, you're actually seeing the lack of change?
I think it varies by company. I mean, I do think some of the larger companies within the sector tend to have more diverse boards. But when you start getting into the small and mid-cap E&Ps, they tend to have almost all of the directors from the oil and gas industry. And I just think there's a common way of thinking that's usually ingrained over decades in the oil and gas industry that's probably not preparing these companies to deal with the disruption from the energy transition. So I think it's incumbent on the CEOs and the boards to embrace greater diversity of thought and background when it comes to putting these boards together.
Maybe we should get some of these Robinhood investors on there. They seem to know what they're doing. What else? Anything that's been pressing on your mind that I haven't asked you about this afternoon?
We touched briefly on executive compensation. I mean, I think that's always a hot button issue, but I do think what's clear to me is that relative TSR within a really narrow band of companies is not the right answer, particularly when we're talking about having companies radically evolve the business model. Because if your only scorecard is other companies that have the exact same business model as you don't really have any incentive to change. So one of the things we're going to be looking for is companies to begin broadening out that relative peer group and thinking beyond just a narrow band of similar E&P companies that actually represents a very small percentage of the overall oil and gas production in the industry.
Yeah, no, that makes sense. I think that's been a big criticism that I've heard also from investors of in and around executive comp. It's like, well, you did better than the other two guys, but what about the 300 people in other industries that are far and away, beating their benchmarks? Mark, thank you very much for your time today. We really appreciate it. I know if there's somebody out there that have had questions, we'll be sure to get back to you quickly after. But again, Mark, thank you very much. Any parting thoughts?
No, I just say I really enjoyed the conversation. Appreciate the opportunity to speak on these issues that are near and dear to my heart, and keep up the good work.
Well, thank you very much. Great to chat with you today. Take care.